Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by an old friend of mine, Colin Clish, who used to be active in the real estate development market in my city. And since then, he's gone on to develop data centers, mostly in the US. And we're going to talk everything data center today. First, Colin, thanks so much for joining me in person podcast interview.
Thanks, Chad. It's great. I mean, I don't do a lot of podcasts, that's for sure. But I was excited to kind of sit down with you and catch up at a minimum. But
Yeah, well, great to have you here. So let's jump in by your background first. So worked at a very large developer, traditional warehouses, industrial properties. You did that until 2015 or so?
2015, then born and raised here in Edmonton. Yeah, worked for Parkland County for some time, and then worked with Remington, established industrial developer here in Edmonton, and then left in 2015 to start my own development company, and then transitioned that in 2018 to a company called PointOne Data Centers, which is the company that I'm a partner in today and president CEO.
So you don't actually even do much work in town anymore. All of your work would be wherever the data.
I was hoping so, right from day one, that we'd sort of be one of the earlier groups to the sort of the Western Canada data center market, and I still think there's opportunity for that. But in terms of obviously Western Canada, Alberta is a major data center market today, and so where we went is we wanted to go to a tier one market, and so we actually ended up to the biggest market in the world and establishing ourselves there. And so that's really where we do Eastern U.S. is primary area for our business, and specifically Virginia, Northern Virginia, Southern Virginia, and North Carolina.
Why is that area the hub? Because I think at one point that 50% of all data centers was in that small geographical area. Why is that?
Yeah, I mean, even in 2017, there was a few what we call tier one markets in the globe, and a few tier one markets in Edmonton. So the top markets of Northern Virginia is the biggest market, was the biggest market, it still is the biggest market. Why is it the biggest market? I think it goes back to pre-dot-com bubble. The network node was established there just outside of Washington, D.C., not only with investments of the federal government, but the early telcos and the early internet companies, established a network node there. And in just momentum of data centers, telco data centers, early internet data centers wanting to be close to that network node. So it's really a network story. And then there's momentum that comes with that, and you want to be, a lot of data centers today want to be near that node of compute and that network node. And so today it still stands as one of the most connected dense network nodes in the world. And so if you're a data center operator or an internet company, cloud computing company, and your customers want to be close to their customers, you really want to be close to a network node, so that I make the analogy of like an interchange, right? Imagine an interchange with 50 or 100, streets and freeways coming into it. Have your distribution, an industrial distribution company, it makes sense for you financially to be as close to that node as possible, so that you can go where you want to. And so that's kind of the effect of a dense network node. And so those network nodes sort of popped up in the top tier markets. And then our market has continued to mature. The data center industry has continued to mature into tier 2 and tier 3 markets. And so it's not as much of a network story today as it was, but it's still a primary component. But that's the, I'm not a network expert, but that's the primary story around Northern Virginia. It's the Washington, D.C. suburb. So there's land, and there's the ability to grow. It's not super urban. It is now, but it wasn't at the time. But it was really a network story.
I remember when you left the development company and then started on your own, and then you went into the data center space. And at the time, it was very early into the process. And I remember somebody even saying, I think Colin went into the call center business. and I said,
got a few of those.
Yeah, I said, no, it's data centers, but that's how early into the stage you were when you first started. And I want to jump into a number of things because I think there's a lot of important topics here. Is that first, the data center industry has exploded, as everybody knows. So now it's gone from being in Virginia to now every municipality is talking about data centers. Anybody that's sitting on 100 acres of land just thinks that it can be a data center site now. And there's so much more complexity to that. And also just the size has gone up. But I remember someone was saying that 10 years ago, a 20 megawatt data center was big. And now you could see 1 gigawatt and larger data centers are at least being proposed. So much has changed. Let's start at the beginning, though. What makes a site? So the Virginia one makes sense. Internet connectivity, they want to be around the hub. But let's just say let's say in Montana, they want to open up a data center in Montana and someone has 100 acres of land. What does that land need to have in order for it to be compatible for a data center?
Yeah, I think one mistake some people make is that it's like one or two just golden rules, right? Like, if you've got acres and you've got power and I've got network connection, I'm in the data center business. I think it's a lot more complicated than that. And so I guess really fundamentally, when we first started in the business, power was more abundant, more available, less constrained than it is today. And so, wherever a data center wanted to be, power is generally available, right? Just like if you're doing any type of development, you assume the amount of electricity you need for that development is there, the utility can provide. That was the case throughout, I think, right until kind of 2021, 2022, where, especially in Northern Virginia and other tier one markets, power constraints started happening. And so what that did is that started a geographic shift for where data centers could go or want to go. Because I think it still remains a general rule today, if land and power were extremely abundant and just take off the shelf wherever you want, most data centers would all be in, a few nodes close to the most dense network place. But that's just not possible, right? Because there's power constraints, land constraints, development, supply limitations. So that has driven demand to markets where we're not traditional markets. So you use the Montana example. I think, that there's no city or place in Montana that would be considered tier 1, 2, or 3 market now. And so I think a general rule is a site has to be developable, right? It has to have basic utilities, water, sewer, and network. But it has to be zoned. The municipality wants to have it as an industrial type development. And today it's got to have a scaled power. It's got to have the right network characteristics, right? And so this is why you're not seeing scaled data centers with cloud compute data centers going to Montana or middle Montana. Not to say there isn't some smaller telco data centers or owner user, data centers in that state. I'm sure there are, just like there are data centers in Alberta. But when we're talking about cloud compute, AI compute, today's big demand drivers in data centers, they're not necessarily not going to be attracted to a place like Montana just because it has power, a network connection, and maybe a cheaper power than they can get in Silicon Valley. Because if you were to find that same land and power characteristic in a tier 1 or 2 market, that would generally be always more attractive to an end user than sort of a place like Montana. So I don't know if that answers your question. It's really not a, I think what people make a mistake about is, if I've got land, I've got power, I've got zoning, and I see there's some internet around, there's some network around that, I've got a data center. So I think there's many more layers to the demand story around data centers, for where customers need to be, what type of compute is it, if your end user customer, who are their customers, who are they serving, what characteristics is that business. So I think it's really hard to, that's what we're going to see play out here, is a lot of people making investments in bringing powered land to the market is what we need, generally the industry generally needs, but there's going to be winners and losers, of course, like in any industry, in terms of where data centers will ultimately go. So I still harken back to office or industrial type. That big built to suit tenant in office or an industrial, they have a game plan for where they want to be. They might RFP a market. They've got their own characteristics for where they need to be in terms of which transportation hubs they need to be close to or where their workers are. They've got their own set of characteristics they need to see. And so you can take that same analogy and apply it to the Microsofts and the Oracles and the Metas and even the AI companies. They all have their own sort of characteristics for where they want to be. So when you think about it, when you back up, you think about how complex that is, it's similar to saying, okay, well, there's a huge office tenant in the market. I can develop the cheapest office building in Lethbridge or in a small town in northern Alberta. You're just not going to be able to attract that to that place for similar reasons. It's going to be hard to attract a data center to a really rural place.
I'll circle back to some other questions on that, but that leads me to a topic that I wanted to get your thoughts on is what happens to the industry? Is there a potential for overbuilding? So there's speculative builds, perhaps even the technology just changes. So instead of needing racks and racks of servers, perhaps it can be shrunk down to a smaller size. And at that point, perhaps these buildings become overbuilt. What happens to these buildings, which are traditionally going to be a lot more expensive to build than just a box warehouse space, and they're not conducive for a normal warehouse or manufacturing space? Two-part question. Instead of overwhelming you with two questions at once. The first one, what happens? Can these buildings be repurposed at some point down the road, and to what cost?
Yeah, I think, when I first got in the industry, repurposing was really important dynamic because primarily capital markets, right? The banks in 2017, 2018, there were way less banks understanding the industry. It's harder to get traditional construction debt. It's harder to get investment. There's less investment. There's less pension funds aren't touching it generally. It's more of a niche type market in the late teens. Now, obviously, it's a lot more supported by capital markets, as we all know. So it's oddly enough less of a story today because of the demand. And so I think generally, every investor I've ever talked to has talked about like, okay, what if we have to repurpose this thing, and what if market shifts changes? That certainly is a dynamic, and I think that that definitely plays into valuations for long-term data centers. I think one of the benefits that we have in our industry is the average tenant in our industry is Fortune. If it's not Fortune 10, it's Fortune 500. So we have great credit tenants in our industry, and our industry is growing tremendously, but just doesn't have a long-term track record. So it is always a question. Okay, well, what if we need to repurpose this building? What happens in 10 years? Well, we just don't know, right? It's like trying to predict technology in 10 years. It's hard to know. So I think from my perspective, my personal opinion is that if we believe that there's a need for more compute tomorrow than today, or 10 years than today, I think a data center that you own that has scalable power and is operation, you may need to swap out equipment. You're certainly going to swap out servers and that sort of thing, but you need to swap out switch gear. You need to densify. Technologies changes. You be prepared for that, because data centers built 5 years ago are way different than the data centers we're building today. And so you look at that going forward. The industry generally knows that there's going to be a lot of different types and styles of development in the future than there is today. So I think repurposing will be important, but at the same time, my personal opinion again is that if you've got a great location and with great power, and you've got the sticks and of a building, you're going to have. We traditionally have very sticky tenants. Tenants don't necessarily have not left. There's been lease turnover, but there's a very few tenants that move around unless they're consolidating. So tenants are really sticky because they're growing so fast. It's hard for them to give anything up because they're having a hard time getting supply, right? So at this time, we don't see a lot of tenant turnover. We see a lot of refurbishing If anything, maybe there's like sale leasebacks of enterprise data centers that get a good amount of investment and retooling. But yeah, so I think long-winded answer to your question. I think there's certainly considerations for what could this building be used for, but based on today's designs, there's not a lot of other uses, I will say. So I think the industry is taking, and then investors and capital markets in their industry are taking a long view that data centers are important in the long-term future and always will be needed. And so, but there still is, obviously, just like there is in other real estate asset classes, there's a differentiation in value, whether you own a data center in the middle of Northern Virginia or whether you own one in Montana. That's going to be tougher to release, or it's the same dynamic as you would see in other asset classes.
That speaks risk in general with what you're mentioning, but I think there's a disproportionate amount of risk depending on the area, as you mentioned. Like it would make sense to me that if you're in a small market in Montana versus a large, vibrant market, you could repurpose that building in the vibrant market by just sheer demand for industrial buildings in general, whereas a vacant data center in Montana, what is the use for that? That could be very interesting. I've heard a lot in the last year or two where, and you've seen this now from starting 2018, where people thought you were in call centers to not knowing what it is to now people are, the average investor is thinking, I should do a data center because I'm hearing about it all the time. Can you get into the process of what's actually involved in taking a piece of land? And let's just say, because I actually came across one the other day in our market, 100-acre site, and they said it's ready for a data center. So let's assume that someone was interested in it and they said, okay, we're going to go and build a data center. I'm guessing you've got to find someone to actually rent that, because to build that on spec would be huge risk. But what is the process? Someone is interested in building a data center because they're so curious about the industry and they think it's a digital gold mine, and they identify a site of land. What is the actual process of getting that into a data center?
Yeah, good question. I mean, it's our industry has certainly, I'll start by saying our industry has certainly changed really quickly. It's changed 2 or 3 times even since 2017, 2018. And it's a function of demand and geographic growth of the industry. So, but that way I would describe it is the way it is today. It's not always been that way. It's like earlier in 2017, 18, 19, a data center developer, in our industry, we call them providers or operators. A data center would have to speculatively start a data center and to be able to win a customer. And even thinking even higher than that, our industry is made up of a number of the hyperscaler customers and has some larger enterprise building and owning their own data centers. So, you think about, they're all a little bit different, but AWS, Meta, Microsoft, Google, all of them, not so much Oracle, but the top hyperscalers, a big portion of their capacity is self-built and self-operated. But then there's I would say a third to a half, sort of generalizing across them, are leased. And generally, I'll say these hyperscale customers ideally want to build and own and operate for themselves, but they are huge and they're growing really fast. And so they've had to rely on developers, providers, operators for just-in-time capacity, or when they have supply constraints and they can't grow in a market, like a constrained market, they're just not able to find the right piece of land that they can deliver when they need that capacity. And so they have to lean on our market. So spinning that back to your question around what is the process? It has changed, but today supply chains is challenging and demand is really high. So what that has led to is there's very few people that if you're an established developer and trusted provider, you've done it before, you don't have to spec, because the way customers are shopping now is generally 16, 18, 24 months, sometimes longer away from their actual demand need. But they love to just take it off the shelf in a few months. Yes, but that supply isn't there. The issue with our industry now is that there are supply constraints, there's challenges of supply, and that's why we're seeing geographic change and in a powered land sort of gold rush, I'll call it, going on now. So if you had a piece of land here that you thought was going to be a data center, if you're in an established market, you likely won't have to spec. You likely, if you've got something that's attractive, you're able to get in front of a customer, a good ways out before you have to start standing a building. But I would say if you have a 100-acre site in Edmonton, in obviously a place that's not an established data center market, I think it's if you had the guts and the capital to do it, and you actually did spec a building, you would get a tenant. It would fill up, but it would be really scary because you'd be spending an extreme amount of money before you have customer support, and so that's challenging to raise capital to do, and so it's speccing a building isn't something that established developers in our space really have to do anymore. So speculatively buy land, yes. Speculatively, get it zoned, acquire utility, acquire network, get it to a place where it's a nice package in a bow with a design and permits and power story. You need to speculatively put all that together and speculatively, get that in front of a customer. But in terms of actually building a vertical building, yeah, we're not seeing a lot of that.
What would that process be time-wise to take that land, raw land, and to convert that? All things, let's say someone did have the appetite to take on that risk and they had the deep enough pockets, start to finish, how long is the process to actually get a data center vertical?
Yeah, I mean, it's a little bit longer than a traditional, industrial building for sure. I mean, I think I liken it to kind of the time frame to build an office building, similar time frame, but there's a multiple factors. So there's the time it just takes to actually do the horizontal development of the site and then the vertical development of the building. Now, obviously, every site's different on the horizontal side, but if you've got a site that's ready to go horizontally and you really data center, it may be 16 months, right? And then it may be some time to commission and actually the customer's going to fit out and build out. It's not instant either. But that base building is, going to be 12, 16, 18 months to build. But the other dynamic that we have is that because of the rapid growth of our industry, suppliers have a hard time keeping up. And so we have a long lead equipment or critical equipment supply challenges. And so as an example, and this is general, and this is certainly broad brush generalizing, but to get a backup engine as a backup generator for a data center now is over 2 years. And there's some suppliers, but that may be different, so I don't want to broad brush too much, but generally the longest lead item in our industry from an equipment perspective is an engine, because they're just really in demand. And so you think about it, you want to spec a building and you're going to take you 16 months to build, you better have ordered equipment a year before that. All right. And then when it comes to switchgear and UPS and transformers and breakers and a whole bunch of other critical equipment that goes into the data center, the lead time for all that equipment is all a little bit different depending on your design and which manufacturer you're going with. But generally, long lead equipment is one of the first things that you're spending money on, other than the rezonings and the acquisition and utility and the land speculative part. But then you're starting to have a supply chain in place. So actually, standing the building is not necessarily the first thing that you're doing if you were going to spec. So that makes it really hard to spec as well. So unless you're a really large established provider, like a Stack or a Vantage or a Cyrus One or a Digital Relay, they have the balance sheet and the growth and the customer base to go into new markets and be more speculative. But when you're sort of that second tier developer, which we're trying to be, it's more challenging for sure. So it makes it that much harder to establish yourself in a new market, let's say like Edmonton, and say, okay, I'm gonna bring the market here, or I'm gonna bring one of my customers here. I think it'll be a lot easier, and you'll probably see first those major established developers and providers make moves into new markets customers themselves make moves into new markets before you'll see the second, third, fourth tier developers, because it's going to be really challenging for them to do.
Yeah, well said. Power. Let's talk power, because I know that's a huge one. And we mentioned we gained 20 megawatts 10 years ago was a big number, although you could still find it. Even the odd manufacturing building, if it was a heavy manufacturer, they might have had 20 megawatts in there. So it was still possible, but that was still a crazy large amount of power. Now you're seeing 100 megawatt, gigawatt data centers. What is the ideal number right now? Is it case by case? Is there a ideal number that people would want to have, or how do you decide what that actual power requirement is? And we'll talk about how you actually get that power after, but how do you determine what the ideal size is right now?
Yeah, sure. I think it's really market based and compute based. What type of compute is it, and where is it? I think those are so again, it's not a broad brush rule that every customer is looking for 500 megawatts or a gigawatt. It's really a power land rush right now because of the constraints that are happening in the tier one markets. So the tier one markets constrained, pushing development and supply into tier two markets and other places, primarily now because of utility. And so I say it that way because if you're going to go, I don't know, I guess I can think about it as a spectrum. If I can develop a 20 megawatt data center, which today is a very small data center, if I could develop a 20 megawatt data center in the heart of Northern Virginia, that's a tremendous opportunity. But if I have a 20 megawatt data center opportunity in Edmonton, I don't mean to pick on Edmonton, but it's where we are. That is the other side of the spectrum. That's going to be really challenging you're going to have smaller customers, really small deals, more telco leasing, more enterprises leasing from you, smaller deals. It's going to be multi-tenant, like even at that scale. But so given that perspective, the other factor is the type of compute. Traditionally, up until, like I say, this year, maybe just before that, it's the primary growth in data centers has been cloud compute, right? And so the cloud compute providers, they've established their compute regions, and they grow those regions. So in those tier one, tier two markets, that's where their customers want to continue to grow, and so they continue wanting to grow there. And so cloud compute, to your point, I mean, don't quote me, but I think the biggest deal that I'd seen in 2022 and before was like a 70 meg lease to a hyperscaler, just the biggest deal, and that's right in the biggest market, one of the biggest developers. And now we're seeing bigger leases, and now these leases they're not, there's a few cases, I guess, but they're not 500 gigawatt and 500 megawatt, 1 gigawatt leases. But what's attractive about that big scale is that customers it's really expensive to develop in one region, and network is really expensive to establish for a customer and for a user. And they really ideally don't want to be moving all over the place, developing here and developing over there and trying to network architect all that. So I think what's happened is because of the constraints in big markets, if we're going to go to a smaller market like Alberta or some other place that's less established, there's going to need to be scale. And that scale we're going to take it down in one lease, we're going to build it all at once. It's not that. It's we need scale so that when we establish ourselves here, that we know we can grow into it, right? And so, yes, the deals are getting bigger and bigger, but at the same time, a gigawatt in any location isn't equal, right? And so a gigawatt is really challenging to find in a lot of markets in the U.S. So that's where we're seeing, some deals being announced, in non-traditional markets, because it's, from my perspective, it's customers, if they're going to go to that sort of a new geography, they need scale. So, and then like I said, it's the type of compute. So cloud compute, 300 megawatt site, that can grow, I think is something great depending on which market it is. There's machine learning demand, which from some customers is more scaled than even 300 megawatts. And then there's AI compute. And now this AI compute is definitely different than cloud compute because it's a totally different network architecture. And so AI compute, what I've seen anyway, is that it can and has less constraints from a network perspective as to where it can go. And so that's why you can see some of the AI training deals being done in new places, right? We've seen North Dakota, we've seen Arkansas, we've seen sort of outside of the traditional markets, these larger deals being done, deep West Texas, because this AI training demand is like now. And so there's power available now in a geographic that's not traditional, then, you may see some customer demand going there. So, I'm not sure if I properly sort of answered your question, but I think it's really, it really depends on the type of customer that would go to this space. So when we're talking about a gigawatt data center today, if that's in a tier one market, you're going to have a really wide array of the types of customers that would be interested in that. If that's in a market like Edmonton, today it may be just AI. It may be just AI training. We're going to see what AI inference, where it needs to be and what kind of network architecture it needs. But today it's these AI training deals that are the big scale and the new geographies that we're seeing.
We talked about this on the phone a couple of weeks ago about Kevin O'Leary's proposed data center, which isn't far from here. It's about 3-4 hours from here in a rather remote area of Alberta. It's close to a small city there, but not a big city by any stretch. And he's proposing 7.5 gigawatts of output when that's fully built out. And first stage, actually I just saw something that he put out the other day saying that he's doing a $2 billion raise so they can do the first phase, which would be about a gigawatt. Is that feasible? Is a project like that, which at one point he threw out it'd be a $70 billion project when it was all built, is a project like that feasible, given that if it is AI training, it doesn't need to be close to a major city? And if so, do we see these start popping up all over the world?
Yeah, I mean, I know our business. I know, the market we're in. I know the characteristics of our customers and our customers want. So I say that because, I don't necessarily understand the business plan up there. I don't, but at the same time, I'm not saying they're not going to be successful. I think that if I was evaluating it for our business or for, let's say, my personal investment, I'd really have to have a thesis around the scale of tomorrow's compute and the continued challenge of finding enough electricity where customers want to go, because obviously that's a really rural location. Today, from my perspective, it's really challenging to get the right network up there. It doesn't, not just a network connection. I think it's going to have the right network architecture that I'm just not aware if that's up there or not. So I think for me, if I was an analyst of it, I would think that you'd have to have a long-term view, and I think some people have this view, and it's certainly possible that the electricity demand driven by data centers and other industries will continue to grow at 25% a year. That's where we're at now, and electricity production is only growing at 3 or 4% a year. Now there's going to be a bunch of reaction, and talking about nuclear. The power industry is really trying to respond. But I think if we're thinking about 2029, 2030 and beyond, I do think there'll be continued electricity constraints if we're still growing, if you believe that compute is going to multiply, the need for compute is continue to multiply, and that we don't necessarily, and we don't see a huge gain in AI model efficiency or compute efficiency. To one of your earlier questions, like if we see, which I think the industry needs, if we see tremendous gains in the efficiency of these compute algorithms, that we just won't need that scale. So, I think you'd have to have for that to work, I think you'd have to have a really long view that demand is going to continue to grow at its current pace, and that the electricity production and the grid itself is just not going to be able to keep up, and that then will drive this expansion, further expansion into geographies, like Cranberry. So I don't think that's where I'd put my business, but they could prove me wrong. I wouldn't be surprised.
I want to talk more on the power side because I do think that is the biggest looming concern, not just in data centers, not just in industrial, but North America wide. And I contrast that to what they're doing in China, where they're having an arms race for power generation. At one point, they were adding a new coal plant every 2 days. They've got the most nuclear facilities either under development or in progress. They're trying to expand their power capabilities at a crazy pace. Whereas in North America, we had one nuclear plant come up in the last 10 years. Amazon is or one of the big companies trying to resurrect 3 Mile Island. The Microsoft, the one that didn't have the meltdown. There's two there. But aside from that, we're trying to shut down coal. We're trying to, or at least there's public opposition to nuclear. So I'm concerned about it, but in your position of having to deal with this on a larger scale, what does happen? What does happen if the demand continues to grow at a pace that far exceeds our availability to supply it?
Yeah, it's a fear for sure. And to preface, I am not an energy expert. I'm a real estate developer at heart, but I'm in the industry every day. So I think you're right on the trends, right? The trends are, compute is growing. Compute is growing at 25% CAGRs every year, and around that level, it depends on how you separate AI and cloud. At that rate, again, we're not. The generation industry seeming to me is flat-footed because they've had pretty flat demand for decades, and so now all of a sudden we have this ramping of power demand. What the industry's feeling now is a lot of energy companies and power companies really focusing on data centers and trying to react. So one of the big dynamics will be, you talk about China, obviously that's a federal focus, right, in an AI compute race, right, and a dominance in the compute space race. Cold Wars of the past, it's like, and now it's like a compute war. And I think, so the U.S. it was a little flat-footed, but certainly the U.S. federal government is focused on this race as well. And so I think what the industry is advocating for, and I think we're starting to see, is the U.S. federal government predominantly looking at the red tape and the challenges that the power industry has, the energy industry has, to interconnect new nuclear plants, or talk about small modular reactors, or trying to interconnect new solar, new wind energy. This is a slow process. These utilities are designed, to be slow and careful, and so a dynamic, fast-moving industry is not a great mix for that. And so we're seeing the federal government really trying to, I think we'll see it more, trying to identify where they can fast forward things, where they can remove red tape, and really try to allow the energy industry to react to the growing demand that we have. My personal opinion is that our compute will continue to grow at a similar pace. I don't know if it's going to be, as hot as it is today forever, but I do think that there'll be continued more demand for electricity and supply for the coming 3, 4, 5, 6 years. I think that's clear. And so I do think electricity is going to get more expensive. I think it's going to get harder to get and find. And so but how long does that dynamic last, right? How long, do small nuclear reactors get adopted, or do they get, are they not supported because, people are afraid of them? I'm not sure, but I think that it's hard to predict. So therefore it's hard to predict 5 or 6 years out, but generally for what we can see 2, 3, 4, 5 years out, we're going to see electricity, I think, is going to get more expensive. It's going to be harder to find. And so that's why we're seeing a lot of on-site generation. We're seeing natural gas and bridge to grid opportunities, on-site generation opportunities become more accepted or more necessary, I'll say, because of the grid constraints. So not because on-site, from my perspective, on-site natural gas generation, whether it's up northern Alberta or whether it's in any other place, gas is generally cheap, but it's relatively more expensive than the grid in a lot of places. And so it doesn't, it's for where we do business in North Carolina and in Virginia, the grid's cheaper still, but in the coming years, we're not sure if that's still going to be the case. And so therefore, we will see more and more on-site generation. Unfortunately, we're seeing some of the plants, shutdown plants, get delayed because of the demand and opportunity. At the same time, I think it's a demand story, and so I do personally hope that I think that we'll continue to kind of find alternative methods of power production and new geographies so that we're not trapped in a market, let's say, that where power becomes extremely expensive and hard to get, and the industry is, and it makes sense to still burn coal. Obviously, that would be not good.
So it still must be challenging even right now, even though the grid can theoretically sustain today's demand, but it's still got to be very difficult to get onto the grid. I can't imagine any electrical company in any area just saying, okay, we'll allocate 100 megawatts to you, and there's another one down the street, we'll just give them 100 megawatts as well. How challenging is it to actually get into those utility agreements right now?
It's way more challenging than it was 5 years ago, and I will preface it by saying it's very geographic specific, right? If you're trying to connect, if you have a new site in Northern Virginia as an example, because that's where I'm doing business, the utility is telling you it's 4 to 7 years from the time that you and I think 4 is even rosy picture today. So if by the time that you say, hey, Mr. Utility, I've got a new site, I have a new demand, by the time it takes to engage in engineering, engage in them studying their grid and understanding what it's going to take to serve you in that location, and then add to that then the long lead time it takes to get a 230 kV breaker and a 230 kV transformer in the substation is like 3 years plus 4 years now. So it's really challenging to get that type of scale grid service certainly in the top markets. And again, that's why you were seeing, the story's not flat across the nation or across North America, because if you're going to a new geography and a utility that's less constrained, that's more excited for data centers, because a lot of utilities in the U.S., they love data centers because they continue to grow, but they've seen a lot of it, and they're not as exciting, and they're getting hundreds of applications for data centers, and so it's not like you're going to a utility that they're seeing this application for the first time, they're excited to support it, and they're doing all they can. That's a little bit easier situation to get scale power. You might find, availability and capacity in certain places, but so that's one of the supply challenges that we have in most markets now, is that it's hard to get equipment and it's hard to get the utilities' attention because there's so much demand. But most of that demand, I'll just say, a lot of that demand is speculative, powered land, gold rush. So you could imagine utilities getting hundreds of applications from every Tom, Dick, and Harry that owns a piece of land and wants to make it a data center. So they're the utilities thinking, oh my gosh, go look at all this data center demand. How much is real customer-fed, customer-backed demand? Not, a fraction of it, for sure. An opposite market demand.
What risk is there on a developer that wants to develop something on spec, goes and gets the power? Maybe they're doing a 50 megawatt site, and they go and get that, but they can't get a tenant for whatever reason. Maybe someone else built a better one down the street. Any number of reasons they don't get a tenant. Are they committing to that 50 megawatts of power for some period of time?
That story is changing too. I mean, when we first started getting in the industry, I think you'd probably find in most utilities around here is that if you can find that 50 megawatts of available capacity in the infrastructure that's there already, then there's not a lot of commitment costs upfront. But in a place that is constrained, that's seeing a ton of application for the same amount of capacity they have, they're becoming more and more harder to deal with. And what that means is, instead of them doing a bunch of engineering for you for free, you're putting down 250 grand for them to just start to see if they can service you, right? And so they're making it harder and harder for the land speculator to grab power. And again, that's in a real constrained market. So if you're in this market, let's say Edmonton as an example, and you're able to, you probably, I'm just, assuming a lot here, but you're probably not going to have to make major commitments to that scale of service if that infrastructure is there. But if you're asking for it and they can't get it to you for 2, 3, 4 years because they have to do a major transmission upgrade or build a substation, or there's major spending that has to occur, then many utilities are forcing developers and customers to securitize that. So you're having to put up major LCs in what we call kind of a take or pay type model, right? So you're having to commit to that power. And so again, it makes it really challenging for a smaller developer to, and in that scenario, to make that work.
What I love so far about everything that you've described is that there are no rules of thumb. Because I think that is the biggest
way to put it. Yeah.
Yeah, is that someone just thinks, okay, yeah, I'll just go and put a data center here. But there's so many complexities between the utility hookups, the costs that might be involved in doing it, any commitments, timelines of doing it, the type of tenant that you actually attract when you get one of those Fortune 10 or Fortune 500 companies, or whether you're piecemealing it off to smaller ones. There's so many nuances that go into this that there's no simple answer. So I think anybody that is considering a data center needs to be very hyper-focused and understand that area, as opposed to saying, well, they built this in Virginia, so I'm just going to take that model and then replicate it in Toronto or in Billings, Montana. There's so many complexities and differences between the two.
I think you're right. And what I would say is, everything I'm saying today, I'm very sure I'll be proven wrong in 2 years, right? Because I've only been in the industry since 2018, and it's changed 3 times already. Like, just a fundamentally changed demand and where data centers will go, what's the demand profile, what is the network architecture has changed a lot. We start off as all service contracts, and that was some more and more net leases. Well, it's changing. And so as much as, sound like I know what I'm talking about today, I guarantee people watch this 2 years from now, I'll be proven wrong a lot, because that does make it challenging as well for our industry too. We've got to be really careful. And if you set your design, let's say today, and you say, I'm going to build this across our sites for the next 5 years, you better be ready for different changes in technology. It changes really fast. And so the level of redundancy, the level of is customer dependent. So it's changing that fast. So it does make it pretty challenging. So I think that's why the industry works well now, because we're able to do more build to suit, right? We're not having to, in the right markets, you're not having to speculate. And then I will say at the same time, the industry does need land speculation, right? It is really hard for the customers and really hard for the big developers to procure and land bank. And we talked about 3 or 4 years out in advance to try to get power. So the industry does need, developers and customers do need land speculators to go out there and ready the land, get it zoned, acquire the utility, put together that power story. Then you do have something of value if you're in the right market, in the right situation, because then someday our company, but also the more established developers and customers, again, they're having a really hard time shopping and land banking many years out. So though there is a business plan still for power land speculation, and because there are customers and users or developers that will need to take to buy that, and we'll pay a pretty penny for it, and typically. And so I think, I don't want to poo-poo all land speculation that's going on, because the industry does need it, but it's a dangerous game in new markets.
Yeah, and it comes with risk. I think there's probably higher the risk you go, higher potential rewards, but also a higher downside risk. So, very fascinating to see this. I want to jump into some of the changes that you've seen, but even before that, the big things that any site's going to need, obviously, it'll need to be zoned accordingly. We'll need to have local government support for it. You'll need power, which we already talked about. I think the two that aren't as obvious, even though people in the industry would find it very obvious, would be the water and then the internet connectivity. And again, I think people in the industry will understand why the water is required, but some people might not understand that it's used as a coolant, and it uses a lot of water. Can you talk about how much water just a data center could use?
Sure. And to that list, I'll add tax regime as well, because I think we can always talk about that. And the tax regime is important for a data center because of the capex size. But to your question, using water in a data center for cooling in an evaporative way, in indirect or direct evaporative way, is a really efficient way to cool the data center. But it uses, to your point, a lot of water, extreme amount of water. And so if you're, in the past and today, measuring a data center's efficiency through something that we call PUE, power usage effectiveness ratio, is if you're using water to cool, your PUE can be a lot lower, meaning your data center is going to be using electricity as efficiently as possible, meaning most of the power that's going into that data center grossly most of it is being used by servers, right? And less of it is being used for cooling and other uses in the data center. So the smaller you can have your cooling use for power, and the more attractive that data center is. So how efficient that data center is, using a tremendous amount of water makes your data center as quite efficient. It's one of the most efficient ways to cool a data center, but it uses a tremendous amount of water. So it's not a golden rule that data centers use water for cooling. There's many data centers, half, if not more than half, will use air-cooled chillers and not use water to cool. There's maybe a chiller loop inside the building, but it's a closed loop system, and they will not use. So that means your data center is a little less efficient. You're using more electricity, but you're using virtually no water, right? So it's not a golden rule that a data center will use water. A lot of data centers design do use a lot of water. So I say 2 or 3 years ago, we see a lot of data centers and customers prioritizing the use of water because they want to be as efficient as possible. But I think over the last 2 years, from my chair, customers have, there's a lot more eyes and there's a lot more reporting that they have to do on how much water they use. And so there's now there's a WUE, which is the water usage effectiveness, like how much water is your data center using. And so when you're AWS or Microsoft or Google or some of the major companies, so are very mindful and watch how much water they're using. There's a lot of eyes on that. And so in many cases now, the customers will favor air cool versus water cool, and simply because they don't want to use that much water. And then we're going to places where there isn't enough water, right? Like even in the big markets, in the big urban areas, there's just not enough. Like they're using a tremendous amount. And so now you're going to new geographic areas where the water systems aren't like you would find here in downtown Edmonton. You're not going to have enough water. So you may be forced to use air cooled and so on, and be a little bit less efficient. So it's not necessarily a golden rule, and I think it's trending away from using water, if you had to ask me, but trends kind of come and go, so we'll see. So if you add a site and you have a municipal water connection, it has to be quite scaled, and obviously when you get into 100 megawatts, 500 megawatts, a gigawatt, it's almost an unimaginable amount of water at that scale. So that scale makes it also possible from my perspective to responsibly use water for cooling. So it's not a golden rule.
Very interesting. Internet connectivity. So I'm guessing it needs to be a fiber line that's going in there. What about redundancies? Because if the fiber line goes down, does the network go down? And I want to talk about you, because you mentioned redundancies on a generator and the long lead times to get those right now. And maybe that's the simple answer on power, but what about redundancies on the network connectivity? How do you address that?
Yeah, I think the first rule I think you would think about is not every customer's network architecture is going to be the same. So again, no golden rule. But as an example, on the side of the spectrum, you're going to have applications and that are extremely network sensitive, meaning they need to be close to a network node, and that specific network node, and 1 millisecond of latency is too much in a lot of cases. But on the other end of the spectrum, again, if you're crypto mining is certainly one example of a type of compute that seemingly doesn't need much more than just any internet connectivity. But in our data center space, that AI training is, again, I'm not an expert, so I don't want to sound like one, but seemingly that AI training type of compute is less network sensitive, and so that's why we're kind of seeing it going to places with less robust network. And the other factor is cost. Like, if you think about it, a network is like a toll road, and you're not just necessarily, unless you own it, as a customer, you have to pay transit costs, and so that's a distance function as well. And so the closer you are, because you're transmitting a lot of data, and the closer you are to the network node, the cheaper your network cost is going to be. The further you are, the more data you're transmitting, it can be extreme. And so that's another sort of layer to the network. It's got to be the right network characteristics, not only from the we call dark fiber availability, like there's availability so that a customer can contract for its private fiber and in a system. And it needs to be the right sort of distance characteristics. And then, to your question, it's in most cases you have less redundant paths, meaning you may be contracted to use a primary path between where your data center is and other data centers that you're in as a customer or the network node. But if something happens to that network, like you said, that we get a cut, we get an interruption, because something happened there, it needs to be redundant rate, right? And so data centers will almost in every case be contracting for redundant pathways back to wherever they want. And customer is specific. So it's really hard to apply a golden rule. I've got network or I don't, or I've got dark fiber and I don't. You gotta have the right sort of network characteristics for the right type of compute that's going to be going into that data center.
Does not having a redundancy kill a deal? Okay.
I think it's that simple. I mean, I won't speak for every type of compute and every customer. I'm certainly not an expert, but from our perspective, from our business perspective, we would never buy a parcel of land that did not have existing, robust, available dark fiber and redundant network paths.
Is that going to be quite challenging in these smaller remote areas where because I could think that bringing in a small rural area where there might be 1,000 people in the town or the village, they're not going to have a high connectivity fiber line and redundant.
Hey, I need 50 pairs of dark fiber. Well, that dark fiber line might have that availability, but does it have multiple paths? It is a massive challenge. And so, again, depending on the customer, they may need to do their own network build. Some of them have their own network characteristics. They own their own network, or they have their own preferred network partners. So further geographically away they are from where they ultimately want to be or where they're transmitting to, can be extremely expensive. And so it has, and that's why we haven't seen a lot of data center development in extremely rural areas. Unless it's maybe like customer built and owned, and they know exactly what they're doing and they've got it all planned out. It's just, so it's hard to be a developer, make a speculative investment in land or in a site and not have a wide enough array of network characteristics so you can serve the specific customer that ends up coming to you.
I'm thinking about it on a different level. On the industrial side, it'd be the equivalent of a distribution company that says, well, we can either locate in the middle of the city or in the city, or we can go find land half an hour outside the town and we'll get land for a fifth of the price. But now all of your additional costs are that much more expensive. Your transportation costs, getting labor, comes with a whole other set of challenges. So it might make sense for a company that's looking in a small rural area, but it might also make sense for them just to pay more to be located in one of the major nodes.
I think that's a perfect analogy because that's exactly what it is, right? It's like you'll see some people may be able to point, well, look, Google went over here, or look, this customer went over here, it sort of breaks the mold. Well, it's a trade-off. To your point, right? Like,
Trade-offs, love it.
It's a whole bunch of characteristics and a trade-off of all those characteristics, right? And so, I think, like I said earlier, a general rule from my perspective is if we could grow, if every customer could grow in the tier 1 markets right next to the network node, they all would. That's where they want to be. But generally, they can't because there's supply constraints, and so there's trades to going to places and new networks, but. And so that's what we're seeing. So no different than traditional real estate dynamics. It's very similar.
That's very interesting. You mentioned tax regime. That's one that I hadn't thought about before, so I'd love for you to expand on that.
Well, you think about the cost. It was around billions of dollars in a data center. Yes, a data center is extremely expensive for a developer developing a turnkey data center. Maybe $12-13 million a megawatt. To develop a turnkey data center. And I'm not an expert, but, what I've heard around in the industry is that if then the customer is putting 2 or 3 times that at least in value of racks and servers and build out in the data center. So if it's a 70 megawatt data center, that's going to be around $1 billion of CapEx for a company like us or a developer. The customer's build out is going to be a few billion in that data center. So huge numbers. And so when you're going into a municipality that has a tax regime that's, let's say, like bringing it back to industrial, that says as an equipment tax, and if servers are considered equipment, then the tax bill, and a lot of the tax regimes around municipalities were never designed around extreme scale of compute. And so, customers used to also go where they were provided incentives by the local municipalities to locate tax breaks, infrastructure deals, because it was really extremely hard for a customer or a developer at that scale to just move into any tax regime. It makes it really expensive. And so tax regimes or municipalities that have, specific computer taxes, and they have a specific depreciation schedules for those, because depreciation schedule of the server is very fast versus a piece of traditional, maybe industrial equipment versus the building. So, it's very important to have the right and competitive tax rates and structure for that customer coming in. Otherwise, it can be completely a non-starter for a customer to move into a certain area if because their tax bill can be incredibly high.
This just adds another layer of complexity. You have all those layer of complexity. So you guys are active right now in North Carolina and Virginia. So what do you guys have on the go right now? What are you focusing on?
Yeah, since 2018, we've put together we have 5 properties in total. We have 4 hyperscale properties, what we call hyperscale properties, that are sites that are, our smallest hyperscale site is 140 megawatts, and our biggest one is potentially up to 1 gigawatt. And so in Virginia, we have about 1 gigawatt of developable capacity in our portfolio. And then in North Carolina, we have a property that's potentially up to 1 gigawatt as well. And so, when we first started acquiring sites, in the industry, a 20 megawatt deal was a huge deal, right? And so we made a play on market adjacency and scale, and that thesis has played out. But also with utility constraints and other supply constraints, we're still a company that's looking to transition from being an aggregator of sites and a developer of land, getting our site sort of shovel ready, utility ready, zone and ready for a customer. We've been transitioning our business. We're raising capital, building our execution team to being a vertical developer. So, it's a really exciting year for us as our first projects are coming out of the ground finally. But what's really exciting for us is we were able to kind of build arguably the top market in the world. We're able to build a portfolio of sites that are in demand today. So it's really about we're focused on execution, and it's really our make or break for our company is can we execute these properties and become a trusted developer and provider like some of our bigger competitors.
So by nature, you have to be thinking 5 to 10 years out at any given time. Where do you think now, 5 to 10 years out from today?
Good question. Knowing that our industry will look different in 2 years, never mind 5 years, it's challenging. Our thesis around geographic expansion of the major markets and powered land, scarcity certainly has played out, and I think that's going to continue to play out. But then, because of the demand we've seen in the change of compute to this AI demand, there's a lot of people currently speculating on powered land, and there's a lot of energy companies entering the space with land adjacent to their infrastructure. So I do think there will be continued in 5 years. There's no question there'll be continued geographic change in the way where data centers are built. And that's just going to be because of supply constraints in the places that the data centers want to be. The fact that the U.S. and like places like Canada are stable governments that have that are trying to break down more and more red tape and support the industry. I think North American data center growth is a tremendous opportunity going forward. It's really challenging for me to think about powered land in a non-established market. But again, in 5 years, Edmonton could be an established market. It's really hard to say. It's just changed that fast.
Never a dull day when you're in an industry that changes that dramatically that fast. I'm sure there's always something to be learned.
But I do know that if you've got invest in, if you've got a developable site in a tier 1 or tier 2 market that's established data center market, and you have utility and you can deliver a data center within 24 to 36 months, you got something that's going to be really exciting. So that's what we're all looking to try to put together.
Funny. Okay, well, it's good advice for people out there. Any other questions that I haven't asked you that I should have? Burning topic, something that you get asked that I haven't asked?
Geez, we covered a lot.
We did. We went through a lot of topics there.
Yeah, I think maybe the biggest theme, I think in my mind anyway, is that I think people have lost scale. When we're talking about a gigawatt, even we have a gigawatt site, but that's 10 400,000 foot buildings, right? And that, I think the province of Alberta is using something like 14 gigawatts.
That's why I can recognize it.
People have sort of lost scale, and I think it's going to be extremely, even though there's a ton of excitement in AI and there's a ton of demand, I think we've kind of lost scale as to like a 500 megawatt project, which is multiple data centers, multiple buildings. Is extremely capital intensive, extremely expensive. And we talked about how much customers have to invest in their compute and network inside these data centers. Yes, they all have announced $50 billion and $60 billion of capex every year in data centers, but that's global, right? And so I do think there's a land and power rush now. I just think that they kind of, everyone's talking about a gigawatt. I think what people should be talking about is not necessarily those grand slams, but thinking about singles and doubles and in the couple 100 megawatt range in the stock markets. I think is where the market really is. And I think there's the 3 Mile Island example that we were kind of joking about, and some of these behind the meter deals that the hyperscalers are doing. I think those are sort of unicorn, that's sort of one-off customer back deals. From a real estate development perspective, I think people have just lost scale a little bit in terms of thinking about everyone using the gigawatt word. I think it's just extreme scale. It's hard to think through.
That's a very good tip. I got one last question for you, because I put out a post on Twitter, or X now, who also is a big user of data now. It's tricky. And I asked the customer. Yep. I asked for questions, and one came in. I'm going to end with this one. Throw them a curveball. Favorite pizza toppings and ice cream.
Favorite pizza topping? Okay, here, how's this? When we'll really fire up your Twitter feed. Pineapple. Something sweet.
That's gonna
juicy, non-traditional.
That's controversial.
How's that? That's good. I say pineapple. If it's not like, pizza in Napoli, in the New York or Italian pizza, we'll say pineapple.
I like pineapple on pizza as well. And ice cream.
I'm a vanilla guy.
I'm saying.
It's hard to be good. There's a lot of, weird stuff out there, but I'm a straight down the middle vanilla guy.
Me as well. Colin, thanks so much for joining me in person. This was awesome.
Yeah, I appreciate it.
Covered a ton of stuff, and really appreciate it. Oh, last thing. If people wanted to get in touch with you, what's the best way?
Yeah, you can. If you want to learn about PointOne, our business, our website is PointOneDevelopment.com, I should say. You can find me on LinkedIn, and not an active Twitter user, but best way to find me is probably on LinkedIn.
We need to get you on Twitter, because there is a vibrant community right there, and you would add a ton of value to it. So we'll try to get you on Twitter. And
I feel like I already type enough. Yeah, sorry to respond every way, but yeah, you're not wrong.
Well, in the meantime, we'll get the website and LinkedIn in the show notes, and encourage people to reach out and touch base with you. And once again, thank you, and thanks for everybody tuning in. That was awesome. Thank you very much.
Thanks, Chad.